What were the early origins of derivatives trading? Imagine a time when farmers and traders needed a way to protect themselves from unpredictable weather or price swings. That's where derivatives trading first appeared. It all started thousands of years ago, around 1750 BCE, in ancient Mesopotamia. People there used clay tablets to write agreements about future delivery of goods like grain and wood. These contracts helped traders and farmers plan ahead and avoid losing money when prices changed suddenly. The legal system, like the Code of Hammurabi, supported these agreements, making sure everyone kept their promises. Temples acted as centers for these trades, blending religious and commercial roles. These early markets allowed people to hedge against risks of shortages or price drops, setting the stage for future financial tools. Fast forward to ancient Greece around the 6th century BCE, where a man named Thales of Miletus made a clever move. He predicted a good olive harvest and paid a small fee to rent olive presses before the season. When the harvest was abundant, he leased the presses at a higher price, making a profit. This was an early form of options, giving him the right but not the obligation to buy the presses at a set price. During the Byzantine Empire and Renaissance Europe, traders and farmers used similar contracts to manage risks in long-distance trade. Italian, Belgian, and Dutch merchants created agreements for future delivery of commodities and securities. Japan also had organized derivatives markets in the early 1700s, especially for rice. They used rice bills, which acted like forward contracts. As trade grew more complex, formal exchanges started to emerge in Europe, standardizing these contracts. By the 19th century, institutions like the Chicago Board Options Exchange helped formalize options and futures markets. These early efforts were all about managing uncertainty and risk. Over time, simple agreements turned into sophisticated financial instruments that still shape today's global markets. They show how humans have long sought ways to balance risk and opportunity in commerce, making derivatives a vital part of financial systems and markets.